Two consecutive massive upward momentum moves. Yes, since the 1930s, how have markets reacted from this event? With the 10% correction now in the books and technology stocks changing trend, is the worst behind us? Well, in today's video, we'll be taking a look at it from both a trader and an investor's perspective, and the results will absolutely shock you on what you should be looking at next in markets. With bonds still showing signs of concern, could this be the warning? Stocks, commodities, and cryptos, this one's not to be missed, guys. We're covering it all right now together. Well, welcome back, everybody, to The Daily Show. My name's Tom, and in today's video, there's a lot to discuss. The latest macro, data, and dark pool activity. Yes, what has Wall Street been up to specifically at the close of the last session? If you haven't already subscribed, remember to do so if you love markets. But let's get stuck into the big points right now, which is consecutive up-day thrusts of a lot of the stock market. Breadth seems to be improving as markets make this recovery, and algos seem to be buying absolutely everything. But should we be putting a bit of a break on this when you start looking at the data stats since the 1930s? Well, as it turns out, we've got quite a lot of reads, and when we've seen this 2 months later, one very big stat starts to come out. 100% of the time, markets have actually been bullish during that period. However, it's what happens in between that I think a lot of you will be interested in. And as we break down the data, depending on whether we're taking into account just the 10% correction or other particular periods, you'll see that it gets very murky over the next couple of weeks. Now, why could that be? Well, we talked about when you have 3 upside 80% plus volume days, it could mean the bottoming of a market. But what we've got so far is 2. And when you see this after a superior rapid drawdown in markets, it often suggests there is still one more shakeout in markets going on. In fact, it turns out that 6 prior instances of this, all of them saw bearish retest lows. So that would suggest that even if we keep rallying here, let's say to the 200 DMA, which we've been talking about, that there is a high chance that we will actually continue to potentially a lower low before actually finding a recovery. And I think this is a very important stat that many traders and investors will be missing out on over the next coming days. And it's something you will need to be paying attention to. Now, why is that? Well, of course, most people believe the market has changed to the upside momentum. Yes, when you take a look at things such as the 5-day EMA, which is a very popular moving average at this point, especially over on X, you'll see that it has broken through. Now, this is the first time it's occurred in all of the sell-off, and it's also happened on some of the most important sectors, considering that we need to be following, of course, what they're doing with technology, as that led the sell, so it should lead the recovery. We've seen breakout. And this is certainly a very encouraging sign for anyone that went and had a look at our previous video, especially late last week, where we were talking about, you know what, this market is just so oversold, it has to have what we call at least a dead cat bounce or a relief rally. Now, we've been reading some of the comments in the description down below, and guys, I do agree with some of you. A lot of you said, well, yeah, even if we do rally, there's probably still another sell to come. That is, of course, a consideration, and the data stats are starting to present the same thing. However, are we still at a point where it still looks very attractive to buy markets? Well, based on at least that particular chart, it does. And of course, when you look at the flows from some of the biggest traders and investors out there, we can see here the latest Bank of America private client flow was huge. And this tends to be kind of near lows. So it doesn't mean that it didn't make a lower low. Of course, back over here, we saw a lower low before it actually rallied up huge, but it is certainly a massive inflow, and people seem to like that level. And for good reason. If you start playing with the 2-month stats a little bit more, such as this one here we shared over on our Twitter account or X account, links in the description down below, and pin comment if you want to follow us over there. We do post a bunch of charts there. You'll notice that the 2-month stats are very, very attractive. 92% of the time, the markets are up off these levels. And while sometimes we will see a lower low, which seems, possible at this point, then we generally will find a rally. So these quick, fast, heavy sell-offs with this type of breadth, with this type of improvement, they tend to be, very important levels, especially over the next, 1 month period to 2 month period. Now, why is this? Well, it's the speed. If you're not aware, this is the 5th fastest sell-off off a high ever recorded. And yes, it's equal to a few other ones, but of course, 3 standard deviation move away from the 50 moving average. And we do love moving averages because you can use these stats with it, which really help you out. Obviously, we suspected we would hit the 200 this year, but you'll also find that in previous occasions, whenever you go through the 200, you usually do recover back to it, that when you're 3 standard deviations over, there is a great chance of a relief rally. And of course, that could be what we're finding ourselves in right now. Now, according to the data of the 5 fastest market corrections, again, the 2-month, 3-month data stat looks phenomenal. 100% of the time, markets would recover as they were coming off a correction from a 52-week high, and it was incredibly fast. Now, there could be a couple of catalysts why this could happen. Tax cuts, deregulation, getting rid of tariffs. All of these reasons, of course, could take markets to all-time highs. As we must remember, technically everything was looking pretty good at the end of last year when you were just looking not so much at the sector rotation, but just looking at the earnings and just looking at the price action. So it takes a lot to really dethrone a market that's been quite inherently bullish. People still do want to own US stocks, but of course, people are also going now to other markets. And one of those markets that we've been discussing now for the last 18 months has been the Chinese market. It was our belief that they'd gone through a heavy recession, although the rest of the world hadn't. And of course, what we saw was a huge move of stimulus. Now, you may have seen this chart going around, and I thought we actually talked about it in our live stream, which we do on the Mondays free, and we do have a private one for everyone that opens and closes Monday to Thursday in terms of the close and open shows. So if you're interested, find the links in the description down below. But take a look at this China M1 money supply. It went ballistic. Now, one of the reasons, well, China's central bank revises statistical scope of M1 flow. And this basically means that now they're suddenly finding where the M1 flow is coming from. They're saying, oh, wait, we're going to go and have a look at the apps. We're going to go and have a look at WeChat and some of those other bank accounts that people have. And all of a sudden it shows huge amounts of money sloshing around in the system. That's not quite the case, but what is the case is China exceptionalism. And this basically means that we are seeing a huge move of flows. Now, it doesn't matter what you're comparing it against to. As you can see here, if you're comparing China to developed Europe, China to the Pacific, China to emerging markets, or China to the US market, it's clear to state here that we have had a significant price action change of trend and that people are starting to invest in China based on government stimulus, based on just generally cheap valuations. Let's be real. Some of the companies, let's say a Google kind of lookalike in China, was basically being traded at 8 to 9 PE. I mean, that's ridiculous. Yeah, that's like less than half of what Google's being valued at. And of course, other companies that are similar to Apple and others were being traded at not much more than that, 10 times multiple. So you can see why people are over there. But what about the US? What about the dark pool activity, guys? What about the big hedge funds, the big money flow? What are they doing? Well, we know that they most likely have transacted the low as a buy. Why? Well, we already suspected this. We shared this over 2 trading sessions ago, and we thought that that could be the low. But as it turns out, there's even more trades coming in. In fact, one of the largest trades we've ever seen just came through IVV. And this is a huge deal. This is one of the biggest S&P ETFs in the market, and there is a cluster down the bottom. And you know what I like? I like clusters of big, large traders. Why? Because it suggests that they are building a position, the BAP. And if they're building a position, you know, we're loving it. So, of course, this is a significant area here, and we need to be paying quite a lot of attention to it. Now, there is also something else to be paying attention to. Did we just see the end of this little rally up for now? Now, it's not that they haven't started building a position. It looks pretty likely they are. But as we saw with the data stats before, there's a decent chance we can make a lower low or come back and retest those lows. A large amount of transactions right near the close just came through. And that doesn't suggest it's going to turn straight away, but it does suggest that we should really be looking at the 200 daily moving average. Where is that on the S&P 500? We'll talk about it in just a moment as we go through the charts, but that's going to be pretty key. Now, why would this timing make sense? Well, we looked at Trump Tariff 1.0, which is 2018 market. And then, of course, we have seen here Trump Tariffs 2.0. Now, when you put them on top of each other, what do you get? Well, you get a pretty cool overlay. And that overlay ends up changing trend at around this week. In fact, we're getting base bottoms near the end of March in the similar period. And then, of course, we ended up seeing huge rallies and the market went well up until this point. In fact, if we actually left the rest of the chart on, you'll notice it gets collapsed on. But the point of the matter is there was still a new all-time high to come. And of course, that this is following a very similar path. I mean, there's no doubt that that is pretty good synergy at this point. Don't take it as gospel, something well worth paying attention to though. What about flows into other on-risk assets? Well, we actually saw for the first time in ages Bitcoin ETF find positive flows. Of course, we didn't in Ethereum. But this is the first good sign, although it is delayed by a day. The 14th of March, this is the actual read for. And you can see here that, as we suspected with price action, that someone is starting to find a little bit of buying momentum inside of the cryptoverse. We've got some extra data coming on that in only a few sessions, and make sure to subscribe because it'll be some good stuff. Now let's go to where the rotations are going. Where are we actually seeing the market buy up in? What are they doing? Well, of course, across the board, it was green. I mean, it didn't really matter what sector you were in. Over the last 24 hours, everything was kind of up. And it was a mix of things. It was gold stock. Nice. We love gold on the channel, of course. Gold and silver doing quite nicely. It was financials. Semiconductors slowed after having some good sessions in them. And of course, we have here consumer discretionary, the worst of the sectors. Now, I think it's important that we keep looking at consumer discretionary this year because when you go to the 5-day rotation, you'll notice it's defensives down the bottom, but still the American consumer does seem weak. Now, a lot of that is because of Tesla. Tesla is a huge component of the XLY, so I'd actually use a different code, which will be equal weighted based on the market. But overall, we're seeing a little bit of weakness in the American consumer coming off the retail sales. And of course, you can see here that semiconductors is actually now one of the best 5-day sector rotations. So it does suggest that Wall Street has started to buy the dip pretty big. And you can see it in the charts. We suspected that if we got through 56 kind of 40-ish area, 56.50, that we were probably going to go up to the 200-day moving average. Now, we do need to be careful of a couple of levels underneath, 54.75 and 5400. They could still be open for the Wall Street kind of algorithms to be buying off, and you'll see this in the options in a moment. But this seems like a very good level as well, the 200-day moving average. Now, why is that? Well, it's the 20 moving average. So you can see here the 20-day moving average and the 200 intersect at around that 57 area. And at the same time, we've seen big volumes off the bottom, exhaustion signs, and of course, just too many puts. Let's be real. There have been so much hedging going on in these markets. So everyone's getting really excited about a rally, no doubt. Of course, we believe there was a squeeze here, and so far that's exactly what it's been. It's been a buy everything style squeeze, and we're continuing to see that. But even if the markets do pull up to the 200, you cannot now not consider that this is possible, a retest of the lows, because the data stats, considering the thrust, considering the algorithm buys, yeah, I mean, it's happened every other time we've seen something similar. Now, that's not to say you don't know anything. Of course, you're just stacking the odds in your favor. And if you bought the dips down here, hey, that's a pretty good price. There's no doubt that that was an excellent area. You're getting a little bit of a reward right now, but there could still be exceptional reward. Remember, 2 months later, 3 months later, the stats change all too positive across the board there. Now, let's have a look at the options data. Does this make sense? 5,700 is where we go from negative gamma, that is the current market we're still in, to a positive gamma style situation. And you'll notice here, it's a very important level. 5,700 becomes this really important level. As of the OPEX expiration, which is this Friday, you'll notice 5,700 has lots of puts on it across the board on that particular session because everyone was so negative over the last couple of weeks, OPEX being quadruple witching this time around, so many different options expirations. We'll talk about that closer into the event if you're not aware of it. But yeah, there's a lot at stake there. So I always thought that this week we should actually be able to rally higher to get above these puts. And that still seems like a possibility. We go towards the 200-day moving average, maybe find a little bit of resistance, maybe find a new low, then rally up. That would seem like the most plausible scenario. It doesn't mean it's going to happen. Of course, follow price action. If I was someone trying to bet on the averages, of course, I've already said I thought the downside risk at 55.50, 5,500 was way less than the upside return, which is always an important thing here. And you can see that 5,600 as well over the next session, not the 18th, but the 19th, is actually going to act as potential support as well. So yeah, 57, 57.50. Of course, you've got some resistance there. in the core wall kind of area. What about the rest of the market though? What about the other big options traded stocks? Well, we saw Nvidia come down a little bit, about 120-ish, 125, 126 still an important level. And of course, for this week, you've got to say that 120, 120, 115, that kind of area is really where you've got the put wall. So basically, you're stuck within these two ranges. If we see really strong momentum, it's probably going to show up in Nvidia first. We know it tends to lead, so that's going to be important there. What about Tesla? More bad news for Tesla as we see even more sentiment survey results coming in showing that people do not want to buy Teslas anymore in certain countries. Look, that's not good. Of course, yes, it's more than a car company, but at the same time, it's hurt a lot of sentiment, and that's why it's down over like 50% pretty much from the top. Well, that's a big pen marker there. But yeah, in general, we can see that we have a 230 kind of put level. The 200 still remains the same. And I would say Tesla is stuck between 220 and 250. And basically, once it's in that range, you're just really looking at buying the dip and selling the rip until proven otherwise. So, of course, that's going to be a very important level for us to watch. And we will continue to cover Tesla. A lot of people say, well, why are you covering Tesla? It's because it's popular. It's got a lot of options on it. And ultimately, there is a huge amount that you can gain from understanding that particular stock as well, because people have a bias on it. So when you have a bias on it, there's actually even better reasons to trade it when you can get rid of the bias, because there are a lot of opportunities which are being presented to us on stocks where everyone has a very strong opinion. They tend to be some of the best if you can get rid of your opinion on them. Now let's have a look at what the bonds market is saying. Is the bonds market said, yeah, that's the dip, that's the total end? Not historically. When we see the bonds market still freaking out like this in terms of option adjusted spread, this is not exactly the market that usually signals the bottom is in. We have said this many times. We've used this market many, many times to back the bottom several points over the last couple of years, and we haven't got a read. Usually you'd expect this to be crunching back down if it was the significant low. Now, that doesn't mean, again, it's guaranteed, but it is further evidence that we have to look at together. And of course, I want to bring that up to you guys. What about yields? Well, off the sales data, you can see here 2-year yields actually went up, 10-year yields stabilized at around these levels. And it's suggesting that as we go into the Fed meeting on Wednesday this week, because remember that we do still have that we're going to be finding out whether we've got a cut potential or whether we're just going to continue to see a hold. And I would think it's going to be a hold. Let's look at the data, blah, blah, blah. But really, I think this is the problem with the market. The market's expecting a potential reinflation that we haven't seen from tariffs that have now been implemented. Of course, we haven't seen those in the data yet because they can't, because they weren't really implemented yet. So this will be an interesting supply chain question. Obviously, we'll get an answer from that a little bit from the Federal Reserve this week. ITB homebuilders, a lot of you disagree with me in saying this is not bad. It's bad. It's not definitely one of my key reads here on long-term economic cycle theory. I talk about it a lot. In fact, I do like to look at homebuilders. But at the same time, you could argue still it's just barely holding on. I think it's kind of looking bad, but it's not enough for me to say, wow, I want to sell everything in the market. It's just a warning sign. And if it keeps getting worse, especially over the next 3 to 6 months, and the markets keep kind of sidewaysing, slowly melting up, then yeah, you're going to want to be paying attention a lot to this. Let's now over the US dollar. US dollar is probably oversold for now. We've kind of thought that this area could be bought up and then it goes like this. Still maintain that I think the dollar is going to be weak this year. And there are certain reasons why that is being engineered in the markets. But at the same time, that is helping, of course, gold, which is well through $30,000 now, and could potentially help gold get to that next level we're looking for, which is all the way up here at 3,600. Now, I don't expect it, by the way, to do this. It's highly likely it does something like this. You know, that kind of thing seems more likely to me. And then, of course, there's bounces in between there. So just be careful with gold at these levels. If you've been in it and you're still holding it, I don't really see any reason to dump significant portions. You just take a little bit off at 3,000 if that was your goal. And of course, that was our goal for a long time on the markets. What about silver? 2 doji style candles. Nice wick rejection there. Bullish style hammer pin bar that came out over the last 24 hours. I'm liking silver. It does look overbought on some metrics, but at the same time, it just looks so good. It's so underpriced compared to some of the other metals markets. And if you've been looking at the metals, you know, not the gold currency metal, but the actual metals that are used in the economy, take a look here at copper. So we've been following copper in our private group and following copper in, you know, some of the live streams. And you know, it's just very strong. And this is China Stim. it's also just, a sign of weakness in the US dollar. And what you're seeing is metals, metals, metals. You've got to remember that about a month ago, we saw a huge shift. What was that? Maybe even 3 weeks ago. It seems like time is slowing down some way. The European Union basically went, we're going to instigate a whole bunch of defense spending. And that requires not so much copper, but it probably does, but it requires a lot of rare earth minerals and metals. And they're being bought en masse because some of those are really rare. In fact, there are some fighter jet metals that I believe and rare earth things that are only owned by a couple of companies in the world. So some of these bottoming bases that you're seeing in the metals market, they're actually phenomenal and they're super cheap in comparison to where they really should be based on all of this wildness that we've seen in the markets. What do you guys think though? Let us know in the comments down below. What about US oil? Well, of course, I think it's about 64 a barrel. Someone can correct me in terms of the break even for a lot of US companies on oil production. We're getting close to that, not really profitable anymore level. And that always has been a bounce for the last couple of years, which you can see here. Has it done enough? Probably not for me. I think that you've got to be really, really, really careful here with oil. It's very political. 68.50 will be the zone that we're watching closely for a rally there. Now over to the stocks. As we mentioned, there's not much to say about Tesla. 250 is res, 220, 200 is buy support, and the market is still, of course, technically down. So you've got still a big sell. I think this is a trade. Personally, I think there is a lot going on with Tesla that makes it harder to invest in, and therefore there's a lot more position-based trading and treating it like a statistical play that I think you want to be doing. But hey, we'll see what the price action does. So we'll keep watching the options market for that. Nvidia, of course, changed trend towards the upside last week, which is a super positive for the rest of the market. It's led to that follow through. In general, to get really going, we need to break 125, 126. And at the moment, you could see it fill gaps, go back to the most traded zone, which is at 115, 116. And we'll see how it reacts off that. If it comes like this, that's a really good sign. So we'll give that a double tick if that happens. And of course, we'll keep following it. The actual surprise or the good stuff there was AMD, exceptional low. We liked this in the live stream. We talked about that. Really nice bottom base. Big break yesterday, change again towards the upside. And of course, one of those horror stocks, which has been a horror stock, Intel. I've liked it for probably a few months now. And Intel in particular, you've just got this huge volume. I cannot get over this accumulation volume. So to me, $30 could happen soon. Let's go over to mags. No follow through. 48 plus, no follow through yet. So this is the Magnificent 7. Looking for that to really show there is signs of significant recovery. So of course we need to be careful. We need to keep those other data stats in the back of our mind. And China just keeps going from strength to strength to strength. There's really no reason at this stage to be afraid of the Chinese market in terms of the stimulus. They're taking, full advantage of this situation and pushing when it comes to setting a series of higher highs and higher lows and just stimming every single time anything's looking bad. So they're continuing to do that. And of course, the money flow is coming in. What about the US 2K? It's actually not a sign of turn here. We didn't manage to get above that significant 2077 wick. And to me, it still looks like it's kind of muddling around at the lows. We will follow the US 2K when it gets more interesting. And actually, the NASDAQ wasn't that great. So if you compare this NASDAQ to XLK, just the tech sector, and you go to like a 2 hour, you'll notice here that you had this 2 hour 20 moving average all the way down. And then you kind of bottomed here and you broke through. That looks like really much better. So I think the XLK sector really recovered here in general. And you can see here the NASDAQ's done something similar, but at the same time, found a little bit of selling near the end of the day. And that's that big transaction that came through that we showed in the dark pool. So just remember that. And of course, we did hit 57 during the futures market. So the market came up, hit the most traded level. For some people, that's a bearish zone. So you've got to be just a little bit careful here. I think the 200-day, though, over the next couple of weeks will be hit, even in the next couple of days. Ethereum, no break. No 2000, no 2000, no 2000. We just have not seen anything going on there. And Bitcoin, you can see here, 84 and a bit. So basically, Bitcoin is still within that coil zone. Which way will it go? A lot of you guys think it's going down. If it is going down, 73 and 68 are the targets. And if it goes up, then of course, we could be looking at significant moves above 100,000 again. So we're watching this very, very closely, coiling up, ready to make a big move. When it comes to this week, really the biggest news is going to be the Federal Reserve, FOMC statement, projections, press conference. You guys know it's about the press conference this week, 2:30 p.m. New York time. Make sure to be on top of that one. And as always, if you liked today's video and you want to find out more about what we do, you can check out our flash sale on courses. And of course, you can follow us over on X as well. And check us out on LinkedIn. I've posted a couple of nice posts about psychology and trading. Follow Thomas Atkinson on LinkedIn. Guys, the summary of today is really that it was encouraging to see those thrust signs. Unfortunately, it does bring that interesting stat with it that I want to share because most people do not know this, that when you have those two so close together after the types of corrections, that it does tend to mean another wipeout is kind of potential in terms of a lower low or at least an equal low. And that is worth keeping in the back of your mind. Although if you did price in very nicely down near those lows, I don't think there's that much to worry about at this stage. It's a very interesting year. 2025 is going to be difficult. Make sure to subscribe and smash that alert button if you want to keep following us and checking out all this content that we're bringing every single day. And it's great to have you here. Thanks so much. Have a great day. Bye for now.